Trading your money is when you buy a stock and you hold on to it for less than a year. Investing your money is when you buy a stock and you want to hold on to it for at least a year, and a lot of times many, many years. I want to hop back to the Business Insider article, that way you can see some of the stats that they talk about. It says, one study looked at people trading Brazilian futures, which is risky, but it found that 97% of day traders lost money over 300 days. And another study in Taiwan found that only 5% of day traders were profitable. And the SEC did a study of Forex traders, and they found that 70% of them lost money every quarter on average. And the SEC even says that traders typically lose 100% of their money within 12 months. And the last one is a study by eToro, which is a brokerage, which says that 80% of day traders lose money within a 12-month period, and the median loss is almost 40% of all of your money. So you got traders from across the board trading Brazilian markets to Forex to stocks, and the common thread that you have amongst all of them is traders are losing money in all of these cases. So you might be thinking, if so many traders are losing money in all of these cases, why do people keep trading their money like this? Well, because you still have the opportunity for a lot of upside. You have some people making a lot of money, and people get attracted to the idea of making a lot of money very quickly, because some people do make a ton of money trading or even day trading, and people get attracted to that idea, so they want to be that person that can make a lot of money day trading. I mean, I have a couple friends who are full-time traders. One of them, I believe, is a day trader, and the other one is more of a momentum swing trader type of person, and they make great livings just by trading stocks. Now, it is very risky, but it also has higher upside. And so you have a lot of people that are attracted to the higher upside, which is why they go towards trading. There's a lot of different trading strategies out there. You have day traders, people who buy and sell stocks within a day. You have momentum traders, you have swing traders, you have people that are looking for potential breakouts. So they're looking at stock charts all day and night long. They're trying to see where are all the charts aligning. That way you can buy a stock right before it breaks out. And again, some people are able to make a lot of money doing this, but most people lose money because of this. I'm not a trader. I don't like that risk, and I don't like the idea of gambling. I don't even gamble in casinos. I've only gambled once, and I gambled $7 when I went to the casino, and I went in knowing that I was gonna lose all my money. I gambled my $7, and I think I went up to $12, but I kept going because I was like, I'm not gonna leave with any money in my pocket, so I continued gambling until all my money was gone, and then I went home feeling comfortable knowing that I only gambled $7, but I haven't gambled since then. But it's not just traders who are losing money in the market. You also have investors losing money in the market, which brings me to number 2. You're not investing in the actual market. The first time I opened up a stock market account, I was in late high school. I don't remember exactly why I opened up a stock market account, but this was around the 2008-2009 crash, and I'm from the Detroit area, and Detroit is known for its cars. So I love Mustangs. And this was around the time where GM went bankrupt and Chrysler went bankrupt. And I loved Mustangs, which are made by Ford, so I decided to put a little bit of money into Ford. I didn't have a ton of money, probably a few $100, and so I put my money into Ford, and I bought Ford when it was trading at around $2 a share, and not that long later, my stock went up to, I don't remember how much, but it started doubling and tripling, and I thought that I was a genius investor because I had put my money into a stock, a company that I believed in because I liked their product, and now I was making a ton of money. I made a few $100s. Now, I learned pretty quickly that I had absolutely no idea what I was doing, because then I tried trading, and I tried penny stock trading, and I tried to do a whole bunch of things to make a lot of money, and I lost a decent amount of money doing that, but I started learning that I didn't know everything. A lot of us will start investing our money in the stock market by just finding a company that we like. I shop a lot at Lululemon, or I shop a lot at Amazon, or I shop a lot at Tesla, and so let me just put my money into this company. And that's a great way to start. But you want to start going beyond that if you want to invest in individual companies, because if you want to make sure that your investment is protected for the long term, so now we're talking about years, then you want to keep up with the company and make sure that this company is actually performing. That way you can get the best return on your money. See, for most people, when they're investing in a company, they really have no idea what they're investing in. They might be investing in a company that they know and that they like, but they might have no idea of what the financials actually look like for the company and what the earnings actually look like for a company. I mean, just ask yourself, if you're investing in individual companies, do you know what the profitability of your company is? Do you know what the valuation of your company is? Do you know what their expenses look like? Do you know what they're investing in? If you don't know the answers to these questions, you have to ask yourself, what are you investing in exactly? You can make a lot of money by investing in a company and holding your shares of this company for a long time, but you can also lose a lot of money if you don't understand if this company is a strong company. Now, a lot of people are not interested in keeping up with companies. They don't want to read earnings statements. They don't want to understand cash flow statements. They don't want to understand the profit and loss statements, which is fine. You don't have to understand these things if you want to make money in the stock market, but you just need to be honest with yourself. That way you're investing in stocks the right way. There's two ways that you can invest your money in the stock market. You can invest your money into the stock market by investing in certain ETFs, which stands for an exchange traded fund, which give you exposure to the general stock market, or you can invest in individual companies, and now you have to hope and pray that the company that you invested in is going to make you money. Because if the company that you invested in runs into the ground, well, now your investment goes all the way down to zero. When you invest in an ETF, now you have this whole group, a basket of companies is what they like to say. You have this whole group of companies, and if one of the companies goes bankrupt, well, you're okay, because you might have 400 other companies in your ETF. These two different strategies of investing into ETFs and investing into individual stocks does not have to be mutually exclusive. I do both. I have a strategy where every single week I have money going passively into ETFs. I have a few different ETFs that I invest in that give me exposure to the stock market because I believe in the American economy. And so every single week there's just more money going into these ETFs, and this happens if the market is up or if the market is down. It doesn't matter. I just keep putting a little bit more money into these ETFs every single week. Then I also have my active strategy where I look for individual companies that I want to invest in. Now, I'm researching companies, I'm trying to find the right company, and these are companies that I want to own for the long term. But this is something that I'm going to spend more time doing. But this is happening passively. That way I can just get exposure to the stock market. You have ETFs for pretty much everything. You have ETFs that give you exposure to the general stock market. You have ETFs that give you exposure to the S&P 500. So this is the top and biggest 500 companies in the stock market. You have ETFs that give you exposure to tech stocks. You have ETFs that give you exposure to growth stocks. You have ETFs that give you exposure to healthcare stocks. You get the idea. There are ETFs for pretty much everything in the stock market. And so now, if you invest your money into an ETF that gives you exposure to the S&P 500, these are one of the most popular ETFs out there. Now, generally, when the stock market goes up, your ETF goes up. If the stock market goes down, your ETF goes down, because now you're investing in the biggest companies in the stock market, the biggest 500 companies. And even if a company in your ETF goes bankrupt, well, you have 499 other companies to balance it out, and then the ETF will kick out that bankrupt company and put in a new company. And so now you're not trying to find the perfect company, you're just trying to invest in the market, because now you're betting that the market will go up. Now, obviously, you don't have the same upside potential as if you invested in an individual company and this individual company exploded, because your ETF now will also be balanced out by some of the losers. But the goal now is to see a less risky but more consistent return, because if you believe in the economy, and if the economy keeps growing, and if the stock market keeps growing, you will see that upside in your ETF. The best way to make this ETF strategy work is to do it passively, meaning either every week or every month or every 2 weeks, whatever. You can pick your own schedule. You're going to have some money, it doesn't have to be a lot, go into these ETFs. That way you're just kind of averaging out the market. You are not trying to time the market with this ETF strategy. All you're trying to do is just keep putting more money in the market, whether the market goes up or the market goes down. When you see a market crash happen, it's not a matter of if, it's a matter of when. That could be an opportunity for you to come in and buy even more, buy more aggressively. But in general, this is a way for you to keep putting your money to work, that we're constantly just keep accumulating shares of these ETFs, that we can get a bigger share of the market. And you're just going to keep doing that passively, whether the market goes up or down. And if and when it goes down, that's when you can come in and buy even more aggressively. Thank you for watching. If you enjoyed the shorter clip from the longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.